Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I look outside of the S&P 500 to look at other indexes within the stock market, also other sectors. And then we also look outside of the stock market to try to get some clues as to what might be happening inside the S&P 500. This is being prepared for Monday, December 11th. The first area that we look at is S&P 500 valuation. We look historically by looking back to see what were earnings reports in the past compared to where price is right now. And then we also look forward to see what are industry analysts projecting going forward from here, because that's really what the market uses. The first chart just shows different static numbers for the PE ratio. We have 10, which is inexpensive or cheap. 15 is considered fairly valued, and 20 or above is considered to be expensive. The black line here is the S&P 500, and we're above the red line, which is the PE ratio of 20. So on a historical basis, we are looking expensive. Then to get a bit of a better look at this, I plot this down below, and this red line is above 0, meaning that we are above the PE ratio of 20. The next area is just to look at some different historical events that have happened, like the 87 crash, the dot-com boom and bust, the housing crisis, and then over on the right-hand side to see where we're at, and we do continue to be overvalued. Now, we don't necessarily use this to make decisions. This is just giving us the overall context of earnings to price, and we want to know this, and we use it as part of our information, but we don't necessarily adjust things based on what's happening on this chart. We use other things to do that. We also look at a more average scale of the PE ratio developed by Robert Shiller, and this takes the average prices over a period of time and then compares them, and this may also be known as CAPE, C-A-P-E. Well, the current reading we're having is at 31.15. To give us some context to what that means, we can look at the historical price chart and seeing now that, for example, back in 1987, we were way down here with our valuation. Back in 1929, we were actually right about here with our valuation. And so we're just about at that same level right now. Does that mean we're going to have a market crash? Not necessarily. We just want to know where we're standing right now. To give us another idea, we look at the median and the mean price, and that's between 16 and 17. We're currently coming in over 31. So according to this measurement, we're also considered to be expensive. But we also look forward. These look much more reasonable. When we look at the S&P 500 and base it on that 10, 15, 20 scale, forward looking, the PE ratio is coming in at 18.9. So we're under that 20 level, but above the 15 level. We also keep an eye on the mid caps where we're under 15 at 13.9. We also keep an eye on the small caps, which are under 15 at 13.4. We can plot all these together on a chart, put them in different colors just to give us some context. They really have a tendency to move in the same general direction with each other. Now, when we look at the small caps, we look at this a little bit differently because there are two main small cap indexes. There's the S&P 600, and that's what I use because it lines up with the 10, 15, 20 scale. Another very popular index is the Russell 2000, and that's on a different scale, and that's in red here, but we can see how these tend to move generally in the same direction. This is something that I picked up this past week from isabelnet.com blogs, charts that they post, and this is just saying the price estimate if we go into a recession or we don't go into a recession. Looking where I'm circling with the pointer, if we just have no recession and we're looking at the 22 times earnings, which would be above that 20 level, this is what the projection would be going forward for the S&P. If we get a little more expensive up to a ratio of 24.5, then this is the green area, and that would put us to an even higher level for the S&P. If we do go into a recession, which is when earnings really come down, then they have us actually going lower with the S&P 500. Also, another thing that's been interesting is there are a lot of central banks out there, not just in the US, that's the Fed, But the Bank of Japan, the Bank of England, and a lot of different banks around the world, they're buying an awful lot of gold right now. And we're seeing that in the statistics here. Then we also look at how are earnings performing. It says the proportion of S&P 500 companies that are beating their earnings estimate, and that is continuing to go up. Now they're projecting that it's going to fall. We don't really know if that's what's going to happen yet, but so far the earnings that have been coming out have led stocks to going higher, but at some point that could turn and start to go down. Another area that we look at is growth versus value. Growth is when you want to buy low and sell high. That's what really moves the indexes. Then there's value type stocks where these may be older companies that maybe their main payout is in the form of dividends. They've stood the test of time. They're generally considered to be safer companies to invest in. And when the market is really going up, folks tend to prefer growth stocks. When the market's going sideways or actually declining, excuse me, then that's when the market starts to look at value stocks. The first thing that we look at is just a pure growth index, and it's still in a downtrend, even though it has been coming back up lately. We also look at a pure value index, which has been bouncing up fairly well here, but it's still in a longer term downtrend. Where this can be really useful for us is when we do ratios between the two. On the top, we have a growth to value ratio showing that growth has been outperforming value, but it has been pulling back lately. And I've been mentioning this in the daily and even weekly videos, and this is a little bit of a concern. We want to see this really going up if we're going to turn more positive on the market. Down below, we have an inverse of that same chart showing how value has been underperforming growth, but lately it has been bouncing back. So we'll keep an eye on this to see if there's more of a shift. We look at some ETFs that measure growth versus value, and we do a ratio where growth has been outperforming, but it has been pulling back. And we've been seeing that now for the last few weeks. Here's an inverse of that same chart where value is underperforming growth, but it has been showing some improvement. And we also look at another measurement or ratio between the two, showing how growth is still in an uptrend over value, but it's really been coming back down lately. And this is an inverse of that same chart, but on a shorter time scale, showing how value has been outperforming, or you could say growth is underperforming when we drop down, but it has been coming back up lately. Then another measurement between growth and value just shows that growth has been outperforming even though it continues to pull back. So we're really seeing some uniformity here in these charts. We also take another measurement here. This is a growth to value ratio, and this is showing that growth is actually doing better. It's outperforming value and starting to turn and go back up. Here's an inverse of that same chart showing how value has been underperforming and starting to go back down. Then we also look at the small cap index where we've been chopping sideways. And I mentioned this in every daily video. We're not really breaking out right now. We're seeing some nice little bounce coming out of the small caps lately, but we're not really seeing that corresponding with the growth to value ratio. In fact, some of the days when we have an upward move with the growth index, we actually end up declining with this ratio. We want to see this turn and go up to turn more positive. And the mid-cap growth to value. This is still hanging in there pretty well, but we've been really bouncing up with the index. We haven't really been bouncing with the ratio between the two. Now, you can also take this in a more positive way. In 2023, it's been the growth stocks that have really been participating. And then to even break it down more, it's been the mega caps that have really been outperforming, and that's what's been helping the indexes move. When we see the value stocks start to do a little bit better, that could just mean there's more broad-based participation. So there's a positive side and a negative side that you can take away from this. Then we look at probably the most important chart that I like to look at is the S&P 500 growth to value ratio. And this is a concern where the S&P has been going up, but the growth to value ratio has been going down. I tend to see this more as a negative divergence. We have to follow the price of the index. That's the main thing right there. But this is just flashing a bit of a warning sign to us. We also keep an eye on inflation. We look at a monthly chart of the CRB index. These are commodities. And this has been coming down, and after it had been going flat lately, We really saw it start to come back up as inflation was becoming more of a concern, and now it seems to be coming down just a little bit. And then we take a ratio between the inflationary areas of the CRB index with the deflationary areas of the CRB index. And this just suggests that inflation has been underperforming, so inflation is going down. We don't want to have this drop too much because then that would be more deflationary. And yeah, the idea of prices going down, you might think, oh, that's really great, but it's actually more destructive than inflation. So the fact that this is leveling out a little bit is just pretty healthy for right now. We also look at the CRB index all by itself, where it has been in an uptrend, but lately we've been seeing some real weakness in commodities. Then we look at the Baltic Dry Index, and there are folks that like to shift and put the S&P 7.5 months ahead or 11 months behind or whatever. I just look at the chart itself. When this is going up, that tends to mean that it costs more to ship products from one place to another, specifically in the Baltic region. Well, it had been really spiking up, but now it's starting to come down, but it's still in a longer term uptrend. Then we look at some other markets. These are markets that I don't necessarily, I'm not involved in these markets, but I'd still like to keep an eye on them. For example, one is aluminum, where aluminum is still in an overall downtrend. We keep an eye on corn. I like to eat corn, but I don't trade in the corn market. That's still in a downtrend. Wheat continues to be in a downtrend, even though it has been spiking up a little bit lately. We keep an eye on fertilizer, which had been really coming down. Then it was starting to bounce. Now it's falling back, even though we saw an increase in the latest reading. Oil, this is pretty influential for all of us, where it really started to go up and then has been coming back down. For right now, anyway, this is still in an uptrend, even though it's been pretty choppy. We also keep an eye on gas, which has been in a downtrend, which is probably more beneficial to consumers because then they're not paying quite as much for gas in their cars or trucks. We keep an eye on the price of diesel, which has also been going down. Heating oil has also been going down, even though it's still in a longer term uptrend. Natural gas also in a downtrend, but it has been coming back up. Now it seems to be going back down. And I think I said downtrend. It's now currently in an uptrend. These lines can be a little hard to see. Copper, which is a barometer of the economy, when copper's going up, that means that things are looking better going forward for the economy. When it's going down, that tends to mean economic weakness. We're still in a longer term downtrend here, but copper has been bouncing back up. It's been really choppy lately as these economic reports are coming out, and some are strong, some are weak, some are stronger than expected, and copper has a tendency to react to those reports. Then we look at the copper to gold ratio. When the economy is looking good, copper will outperform gold. When there's some concerns, not only economically, but also geopolitically, that's when we see gold outperforming copper. Well, lately, copper has been making a comeback, even though we have been declining in the copper to gold ratio. We look at this on a longer term chart. That's the black area where it's been declining, meaning that copper's been underperforming gold. We plot the 2-year yield and the 10-year yield, which are coming down. For the most part, interest rates have been declining lately, but we're still seeing that all of these lines are pretty far from each other. They tend to move in the same general direction, and even though they're on different scales, they tend to not get all that far apart from each other. They've been far apart from each other now for the last couple of years. We keep an eye on gold. It was kind of making some news recently as it was trying to break out to the upside. But usually when that news hits, that's about the time we've topped out and then we start to fall back. However, we have crossed over and we're in a positive trend with gold. Silver, which also tends to really follow gold, it had also been breaking out, now pulling back. It still is in a longer term downtrend. Then we look at the closing value for gold on the top, which has been declining lately, as has silver. And then we look at the correlation between the two, and they have a fairly strong tendency to go in the same direction at the same time. Then we do a study here. This is the gold to silver ratio on top. When this is going up, that means gold is outperforming. When this is going down, that means silver is outperforming. And what's interesting about this, we can plot the US dollar index in the middle, and we can make some general observations from this. When this is going up, that tends to mean that gold outperforms silver. Now, gold can be either going up or down. It just means, or gold and silver can be going up or down. It just means that gold is going a little bit faster. And then when this is going down, that means that silver has a tendency to outperform gold. And we've been going up lately, meaning the gold has been doing better. We leveled off, and now we've been starting to come back down, meaning that silver lately has been outperforming gold. We also look at the performance of the correlation at the bottom, where they have had a really strong tendency to go in the same direction. That's comparing the top chart with the middle chart. But lately, we're seeing a little bit of weakness in this relationship. We look at the US dollar index, which continues to be in a longer term uptrend, even though it has seen some recent weakness. And then we look at the euro compared to the dollar, where the euro had been rebounding after it had been declining against the dollar, but now we've seen a little bit of strength in the dollar recently, and so the euro's been coming down. We also keep an eye on the Japanese yen, which really spiked up. There was some news out of Japan that really helped bump up the price of the yen, but overall, the yen is still underperforming the dollar. And then I have some individual charts here. This is the euro to the dollar, where the euro is underperforming on a trending basis. It had been showing some improvement, but now is starting to pull back down. Here's the Japanese yen. Even though we saw some bounce this past week and in December so far, it still continues to be in a longer-term downtrend. The British pound to the US dollar also is in a downtrend. Even though it bounced back up, it's now been pulling back. We keep an eye on the different indexes, and I show this in the daily video. The red line is the equal weight S&P 500. That treats all the stocks in the index the same, where the S&P 500 itself is a weighted index. So when you get the mega caps really moving up or down, that can have a real big impact on the price of the index. When the red line is underneath the bar chart here, that means the equal weight index is underperforming. We have been improving with both indexes, but the equal weight index continues to underperform. We look at a ratio of the S&P 500, which are stocks, and compare it with the CRB index, which are commodities. And we're seeing that the S&P 500 is beginning to outperform the CRB index, and we're getting ready to see a golden cross with this ratio. Here's an inverse of that same chart where the CRB index has been underperforming, and we're starting to see a death cross with this ratio. Then we look at the NASDAQ 100 and compare it with the S&P 500. Both have been doing quite well in 2023, but the NASDAQ 100 has been doing even better. We look at the S&P 100, which are the biggest stocks in the S&P 500. We did see some weakness at the latter part of November, but now we're starting to come back. But we're getting really close here to what could be a death cross with this ratio. If we see more improvement with the S&P 500, we might avoid this turning into a downtrend. If we see more weakness, we might end up seeing this be a downtrend. This could be a potential early warning sign that maybe stocks are running into some problems. Then we look at the NASDAQ to S&P 500 ratio, showing how the NASDAQ has been outperforming. We look at the NASDAQ 100 and the NASDAQ. Both have been doing well, but the NASDAQ has been doing even better. We look at the mega caps. These are the big monster companies that pretty much everybody's heard about. And we compare it with the equal weight S&P 500, showing that the mega caps continue to outperform and are in a longer term uptrend. We look at a ratio between small caps and the S&P 500. That's the red line. And we've been really underperforming for most of 2023, but we are starting to see a bounce. There's this speculation at this point. Are we going to have what's known as the January effect, which typically kicks into gear about the middle of December and goes well into the new year, where small caps and even mid caps tend to see a lot of favor and might see a bounce going forward? We're not really seeing any confirmation of that in our charts, but historically that is what's happened, and we're wondering if that's going to happen this year. And here's another ratio between the small caps and the S&P, where the small caps have been really underperforming. They're bouncing back, but we want to see this really go up if we're going to turn more positive with the small caps. We look at the biggest software companies, where they're still in a downtrend, even though they're coming back above their moving averages. We haven't quite crossed yet to give us a golden cross. Here's the mega caps. These have been the real big performers in 2023. They continue to be in a really solid uptrend, but they haven't come quite back to their all-time high yet. We're wondering if that's going to happen. We look at the robotics and AI ETF, which is showing some improvement. It spent a lot of 2023, especially over the summer, as stocks were going up. This was not doing as well. And then when we hit some more problems in the latter part of the summer into the fall, this still continued to go down. When we compare this, the robotics and AI ETF to the tech sector, it is continuing to underperform, even though it's showing some improvement. We look at the Dow Jones Composite Average, which is the Dow, the transports, and the utilities, and we put them together. We're still in a longer-term downtrend, even though this has been showing a bit of a bounce. We look at the S&P 500 and compare it with shorter-term bonds based on price. Stocks are continuing to outperform shorter-term bonds. Then we look at the broad market and compare it with further out bonds, also showing that stocks are outperforming the price of bonds. The low volatility stocks, which held up better in 2022, they've been chopping around and they're still in a downtrend in 2023, but we have been seeing them bounce back up recently. We do a ratio between the low volatility stocks and the S&P 500, and it just shows that the low volatility stocks are really underperforming. We're starting to break down below these previous lows with this ratio. We look at the tech sector and compare it with further out bonds, showing how the tech sector is outperforming. Then we look at some other stocks. This is an advanced decline line study that I've shown in pretty much every daily video, but we are seeing some improvement here. This top one is the NYSE Common stock, and that's above its moving average. Then we have the S&P, which is showing improvement, the mid caps and the small caps. So this is suggesting that under the surface, things are showing some improvement, at least currently. We take a look at Dow theory, where we were up in Friday's session, and the Dow's really been breaking out, and it's been a fairly well-performing index lately. What's a concern to us is we're seeing the transports actually start to go down. And in a good, solid environment, we want to see the transports doing well, and they're just not doing that. Utilities have been under a lot of pressure. They've been trying to bounce back up lately, but they were down in Friday's session. We look at a ratio between the transports and the S&P, and this ratio is now starting to go down. To get more positive for the S&P, we want to see this ratio going up, and it went up, and now it's immediately starting to come back down. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. When this is going down, that means the transports are outperforming, and we're pretty much chopping along sideways currently. We look at the relationship between the S&P and the transports, and we're seeing that relationship start to weaken just a little bit. So the S&P has been doing well. We've been in a trading range, but we're at the high end of that range. We're also wondering if we're going to come back to this previous high set in July. But you see where the transports, they're not even close to this high. So that's a bit of a concern for the market. We take a new approach to Dow theory. Instead of looking at the Dow on top, we look at the S&P 500. Instead of looking at the transports, we look at the NASDAQ, and we're seeing where the NASDAQ is coming back to these previous highs, and we're also back to these previous highs right now with the S&P. So they're pretty much confirming each other right now. Now, if one really breaks out and the other one starts to go down, that would be a concern to us, but we're not seeing that yet. The FANG index, this is Facebook, Amazon, Apple, Netflix, Google, and some other stocks. It had been drifting lower with this index, even though we were still positive, but now we're starting to show some improvement. We're wondering, can we go back and test these previous highs? We still continue to be in a longer-term uptrend. This is the all-time high that I'm talking about. The FANG index has had a real difficult time coming back up and setting a new all-time high. Sometimes we can break through on an intraday basis, but by the time we close, we either come up to the red line as we did on Friday, or we come back down below the red line as we've done recently. ARC, which is showing some improvement now, it's just about getting ready to cross over to give us a golden cross here as we are getting closer up to the 50 range. We did get back up to this level earlier in the year. Are we going to be able to break through that, or is this going to provide overhead resistance? Then we look at a monthly chart of the S&P 500 and compare it with stocks in Europe, Australia, Asia, and the Far East. When this is going up, that means the S&P 500 is outperforming. And then we measure this using a momentum oscillator where it's positive, but it's starting to roll over as stocks have been running into some difficult times in late summer and into the fall. And we look at bonds, the total bond ETF is starting to bounce back up, but it's still in a longer-term downtrend. World bonds also bouncing up, but still in a longer-term downtrend. The stock to bond ratio on a monthly chart shows that even though we're turning over slightly, stocks continue to outperform bonds in the long term. And this is a shorter term chart showing how bonds are underperforming stocks. Then we look at high yield corporate bonds, which are junk bonds, and they tend to follow the stock market. After seeing some weakness, they're starting to really come back and show some improvement. These are investment grade bonds, which are more conservative. We still are in an overall downtrend, even though we've been seeing lots of improvement lately. And then we compared the riskier bonds like junk bonds to more conservative bonds like government bonds, and it's showing that the riskier bonds are outperforming. And if I recall, the yield that they get for junk bonds is about double what you would get for government bonds. So people are willing to assume that risk. They'd rather get the yield and take on the risk than get a lower yield and be safer. Then we look at a correlation between stocks and bonds. They're coming back down to close to this neutral area, but they're having a slight tendency to go in the same direction. So if stocks are going up, bonds are probably going up and vice versa. Here's the Dow Jones Corporate Bond Index, which is still in a longer-term downtrend, even though it has been recovering lately. This is the 10-year yield, which we got all the way up to 5%, and now we've been coming back down. As interest rates are coming down, that tends to give more support to stocks. And then here's a longer-term look at the 10-year Treasury yield, where for 40 years we were seeing lower highs and lower lows. Now we're starting to break above that, even though we've been coming back down. We're wondering, are we shifting into the old norm as far as interest rates, where not necessarily in the last 40 years, we've seen lower interest rates, but throughout most of history, we tend to be in a more higher interest rate environment. We're wondering if we're going to shift back into that kind of an environment. We look at the 30-year yield, which has also been coming down lately. And then we look at the S&P 500 and compare it with the rise or fall in interest rates. This just shows that stocks have been outperforming the rise in interest rates lately. Here's junk bonds, what they continue to be in an overall uptrend when we look at them by themselves. And then we do a ratio between junk bonds and government bonds, where this has been pulling back lately, but junk bonds have, for the most part, been really outperforming more conservative bonds. And then we look at the 7 to 10-year ETF for bonds based on price. And this has been showing a little bit of an improvement here. We were able to get back above the 200-day moving average. And when we look at the MACD on the bottom, this shows that momentum is still positive, and the RSI on top is still above 50, even though we saw a bit of a pullback down below the 200-day moving average in Friday's session. This is a longer-term look at the different maturities, where overall we have been declining with interest rates, but we had a really strong employment report that came out on Friday, and that bumped up interest rates, at least in the short term. Here's a weekly chart showing that the US and UK yields have been coming down, but they're the highest, followed by German rates, and then the red area are the Japanese rates. We look at the MOVE index on top, which measures the volatility of bonds, the VIX index, which measures the volatility of stocks, and then on the bottom is the correlation between the two, and it's not really strong right now anyway. Sometimes if bonds are really volatile, then stocks might be volatile and vice versa. But we're seeing there's really no volatility in stocks right now. You can see the VIX is very, very low, where there's been a little bit more volatility with bonds as interest rates are gyrating around. We have a monthly chart here of the price of the 30-year bond, where it continues to be in a longer-term downtrend. We take a ratio on the bottom between the price of the 30-year bond and the CRB ratio, and it's showing that the price of bonds is continuing to outperform here, but it is rolling over. But this is a monthly chart, and it can take a while to update. Then we look at different sectors. We compare 11 sectors in the S&P 500 with the S&P 500 itself, showing that materials continue to underperform the S&P, Communication has been a stronger area and is outperforming the S&P. The energy sector, which was trying to make a bit of a comeback, and it's still in a longer-term uptrend, but this is really rolling over. Lately, we've been seeing energy prices really underperforming the S&P 500. The financials are starting to look a little better. We declined back in March when we had the banking crisis and then spent most of the year going sideways. Now we're slowly starting to see some improvement when compared to the S&P 500. The industrials continue to underperform even though they bounced up recently. The tech sector has been a stronger area in 2023 and is outperforming the S&P. Staples continue to underperform the S&P. Real estate was trying to make a bit of a comeback, but is still in a downtrend when compared to the S&P, and utilities are also underperforming. And here's an S&P to utilities ratio. When this is going up, that means the S&P is outperforming. When this is going down, that means utilities are outperforming. And we've been really choppy lately, so we haven't been getting a real clear direction from this chart. Healthcare continues to underperform the S&P. And then here's another look showing that healthcare is in a downtrend. We look at discretionary, which had been stronger earlier in the year, and it's still in a real weak uptrend right now. It's showing a little bit of an improvement with the performance here, but discretionary hasn't been as strong to really give us a lot of support in the market. Staples, which are things you have to have no matter what's going on in the economy, it is in a longer-term downtrend, even though it has been bouncing back up lately. And the tech sector continues to be in an overall uptrend. We look at the semiconductors, which are also looking pretty strong currently. And we take a ratio between the tech sector and the S&P, showing that the tech sector is outperforming. Then we look at energy versus tech, showing that energy is continuing to underperform and is in a longer-term downtrend when compared to the tech sector. Then we look at the growth areas, the buy low, sell high type of stocks, and we compare it with bonds, which are more conservative. After pulling back down recently, the growth appears to be showing some improvement and is in a longer-term uptrend. We look at the tech sector with the rise in the 10-year yield, showing that even though the tech sector is bouncing back up, it's still in a longer-term downtrend. Here's an inverse of that same chart showing that the 10-year is starting to underperform the tech sector, but is still in a longer-term uptrend. We look at a ratio between discretionary and staples. And even though discretionary has been kind of weak, staples have been even weaker. And so when we look at this ratio, it's showing that discretionary continues to outperform. Then here's an inverse showing how staples are underperforming discretionary. Here's gold, which really started to break out, but then stocks started to go up as gold was coming down. So we're seeing this ratio coming back down, and it's still in a longer-term downtrend. We also look at a ratio between gold and the dollar, where it was trying to break out and has now been pulling back. High leverage loans, which are still holding up quite well. And as I say, every time I do this, if the economy was getting ready to really fall apart, would we really see this going up as strong as it is? Because these are risky loans. No, this would be falling apart, and we're just not getting any warning signs from that right now. Here's the NYSE composite, which is improving, but still in a longer-term downtrend. International stocks are also improving and never did lose their uptrend, and so that's starting to look a little better. Emerging markets have been chopping more or less sideways and continue to be in a downtrend. The microcaps, which are really small companies, they continue to be above 100 and are showing some improvement. If we do get that January effect, it may end up benefiting the microcaps as well. Then we look at the home builders study here, where we have the S&P on top, and you can see we've been chopping sideways. We're just at the upper end of the range, where the home builders ETF has really been doing quite well. The ratio has been going up, and the correlation between the home builders and S&P is pretty strong. When we really notice this is when we see them going in opposite directions, and I have them marked as these yellow areas, and that's not happening right now. Bitcoin is enjoying a little bit of a surge higher. We got up into the 44,000 range now and is in a longer-term uptrend. Then we look internationally, where China is more in a downtrend. And we use the KST, which is a momentum oscillator, to measure this. We're also rolling over with the emerging markets. We're pretty much flat to slightly down with Europe, where we're flat in Japan, where the S&P is also kind of flat right now. If we see more follow-through upside, this could turn and go back up. Then we look at an intermarket analysis chart. This goes back to the beginning of the year, and stocks have been performing the best, followed by gold and then the dollar, where energy and bonds based on price, are now negative on the year. We look at some different correlations. We look at the S&P 500 and how it's related to the dollar index. They're having kind of a tendency to go in the same direction, but they have been neutral for the last couple of weeks. We look at the correlation between the S&P 500 and oil, and they are having a slight tendency to go in opposite directions from each other. And we look at the S&P 500 with the 10-year yield, also slight tendency to go in opposite directions. And the tech sector to the 10-year yield, they're more in neutral territory right now. And we look at the S&P 500 to the 2-year yield, a shorter maturity, where they're having a slight tendency to go in the opposite direction, but this has been coming back up to the neutral area lately. And we look at some long-term trends. On top, we have the NYSE, which is a broad market measure that we look at, and this is a monthly chart, and we're above the moving average, so that is positive. When we look at the Copic curve, which is a momentum oscillator, this is continuing to go up. So this is showing that in the longer term, in the broader market of things, we are still looking positive. Then we look at a daily chart of the NYSE, and we're starting to show some improvement when we look at the record high percent index. When we were going down, that was more over the summer, and now we're starting to see some improvement here. Then we look at the S&P monthly chart on top, and we're also above the moving average. So that's positive, and the momentum oscillator is also starting to go back up. So longer term, that is also positive. And we look at the S&P with a daily chart, also looking positive here. And then we look at a ratio between the S&P and the CRB index, showing that stocks continue to outperform commodities, at least in the longer term here. And then we look at the S&P 500 and look at another global index. And this is a ratio. So when this is above the red line and going up, that means the S&P is outperforming. The KST is showing some improvement, but it's still just a little bit negative. Then at the very end of this video, I look at all those things that are positive and I make a list, and those things that are negative. And my definition of positive is when the 50-day simple moving average is above the 200-day simple moving average. So we have the CRB index, even though it's been pulling back, is still in a longer-term uptrend. The dollar, gold, mega caps, the FANG index, bonds, which when we look at the high-yield bonds or junk bonds, those are still positive. Tech and semiconductors are positive. High leverage loans, the Dow, the NASDAQ and NASDAQ 100, all stocks. And then it's hard to see, but there's Bitcoin down there at the very bottom. Then we look at those things that are negative, and that's when the 50-day moving average is below the 200-day moving average. Both the growth indexes and the value indexes, even though they're both negative right now, growth over the longer term has been outperforming value. Silver's still in a downtrend. Copper, the Japanese yen, the euro, and the British pound are all in downtrends compared to the dollar. The big software companies, even though they're improving, are still in a downtrend. The Dow Jones Composite Average, the low volatility ETF, ARK, and it's just about getting ready to give us the golden cross. So probably when I do the video next week, if ARK still does better, I'll probably switch that over to the positive side. The NYSE Composite is still negative, even though it has been showing some improvement. The staples sector, the total bond ETF, world bonds, mid caps, small caps, and micro caps. We're coming into that time. Are we going to see the January effect? We don't know yet. We're just kind of waiting. At least historically, that's what has happened, but there's always exceptions to historical averages. And then emerging markets continue to be in a downtrend. So thank you. I really hope you found this helpful. This is not necessarily meant to be a standalone video. At least for the videos that I put out, it would be more helpful if you could watch the daily videos and the weekly video. And then after this, I will be putting out what I call a deep dive video, where I go through all of the daily charts and pick out those charts that I really didn't talk about this past week, because sometimes we can get some insight from doing that. So have a really good weekend, and I will talk to you in the next video.